Hey there, future traders. Are you ready to start trading but don't know where to begin? Well, you're not alone. Whether you're looking to build financial independence, grow your wealth, or just learn a valuable new skill, trading could be the perfect opportunity for you. But here's the thing. Many beginners make mistakes that can cost them big. Things like letting emotions drive their trades, or jumping into the market without a clear strategy. Trust me, I've been there too. But don't worry, that's exactly what we're here to avoid. Before we dive in, don't forget to hit that subscribe button, give this video a thumbs up, and share it with anyone who might find this info helpful. And hey, if you've got any questions or thoughts, drop them in the comments below. I'd love to hear from you. Alright, let's get started and unlock the secrets of smart trading. What is trading and who takes part in it? Trading means buying and selling different types of financial assets to make a profit. These assets can include traditional ones like stocks and bonds, or others like currencies, commodities, and even cryptocurrencies. The trading world is like a big financial marketplace, with many different people and organizations involved, from everyday individuals to big financial companies and even government banks. Key features of trading. 1. Many types of assets. You can trade both common and more advanced financial products. 2. Lots of participants, from individual beginners to large financial institutions. 3. Open to everyone. You can start small or grow big over time. Who's involved in the market? Retail investors, regular people like you and me who invest their own money. Banks and brokers, big companies that trade in large volumes. Investment funds, professionals who manage money on behalf of others. Central banks, government institutions that help manage and stabilize the economy. All these players make the trading world dynamic and fast-moving. They use different strategies and have different goals, which creates a constantly changing environment, full of both risks and opportunities. Key differences between investing and trading. 1. Time frame. Investing equals long-term, months or years. Trading equals short-term, hours or days. 2. Frequency. Investors make fewer moves. Traders are constantly buying and selling. 3. Type of analysis. Investors use fundamental analysis, studying companies and the economy. Traders use technical analysis, charts and price patterns. 4. Activity level. Investing is more passive. Trading is hands-on and active. Both strategies require knowledge, discipline, and risk management. Whether you choose to invest or trade depends on your personality, your goals, and how much time you can dedicate to the market. Choosing the right market. Financial market overview. Q1 of 2025. At the beginning of 2025, many expected that a possible Republican administration in the U.S. would strengthen American exceptionalism, and that America First policies might hurt other global economies. But reality turned out different. U.S. trade and political uncertainty weakened domestic growth prospects, while Europe surprised many with stronger fiscal policies. Key highlights. Emerging markets like China and South Korea outperformed developed ones. Value stocks did better than growth stocks. Small-cap companies dropped by 3.6%, mainly due to inflation and trade concerns. Commodities led the way, with gold jumping 19%. In the bond market, U.S. Treasury bonds returned to 0.9% as recession fears grew. German bonds dropped 1.6% due to higher issuance expectations. Japanese bonds were the weakest, down to 0.4%, hit by rising inflation data. The role of stock trading in financial markets. Stock trading plays a crucial role in how the market works. Companies sell shares to raise money, to pay debts or fund expansion. Investors buy those shares to gain ownership, earn dividends, and sometimes influence decisions. How stock markets work. Companies offer shares to the public to raise capital. Shareholders get voting rights and a share in company profits. Investors trade shares with each other on secondary markets. Prices are set by supply and demand, the basics of trading. Transparency is ensured by rules and public reporting requirements. Economic role of stock markets. Stock markets act like a thermometer of the economy. When prices rise, it shows investor confidence. When they fall, it often signals worries about the economy. The Forex market, origins and evolution. In 2020, the global foreign exchange, Forex, market reached $2.40 quadrillion in daily volume, according to Daily Forex. Unlike stock markets, which have been around for centuries, modern Forex is still relatively new, but the concept of exchanging currencies dates back to ancient times. Old roots, modern market. The core idea of Forex, trading currencies for profit, existed since the first coins were made. Ancient merchants would arbitrage by taking advantage of differences in the gold content or value between different coins. Back then, Everything was local and slow. That changed with the digital age. The digital revolution thanks to the internet. Forex became a 24/7 global market. Real-time trading driven by global supply and demand. Lower currency risk for global companies. Incredible liquidity. Trillions traded every day. Why it matters. Traders like George Soros have used Forex to challenge central banks. The market acts as a global fiscal watchdog, helps prevent runaway inflation in economies with weak currencies. Forex is key to the global economy, in a world without fixed monetary systems. The key role of commodities in global markets. People often focus on stocks and Forex, but commodities are the foundation of the global economy. They support entire supply chains, feeding industries worldwide. Two types of commodities. Hard commodities, natural resources like oil, gold, copper. Soft commodities, agricultural goods like cattle, wheat, sugar. Why commodities matter. Diversification, they don't always follow stock or bond markets. Inflation protection, commodities often perform well when interest rates rise. Strong returns, many commodities have gained value since the pandemic. Why they're still important in 2025. In a world with rising inflation and shifting monetary policies, commodities offer a natural shield against market volatility. They help balance investment portfolios. They provide exposure to real, tangible assets in uncertain times. Smart investors include commodities as part of a well-rounded, resilient investment strategy. Getting the right tools and platform. Accessibility and smart choices in trading. Thanks to technology, trading is now more accessible than ever. Today, anyone with an internet connection can open a trading account using one of the many platforms available, but choosing the right platform makes all the difference. It can improve your overall trading experience, your financial performance, and how easily you manage your investments. The rise of online trading platforms. Digital platforms have revolutionized investing. Now, individuals can manage their own portfolios directly, without needing a financial advisor. With a single platform, you can access company stocks, investment products like ISAs and retirement accounts, various funds, such as ETFs and mutual funds. Key features to look for. 1. Basic functionality. Platforms connect investors to brokers, let you open, manage, and close your positions. Many offer free access, depending on account size or trading activity. 2. Different account types. Options for margin, cash, retirement, or self-directed accounts. Trade across various asset types like stocks, bonds, and derivatives. 3. Advanced tools. Real-time quotes and interactive charts. Financial news and in-depth research. Custom tools based on the asset, e.g., Forex, options, futures. Top platforms combine powerful features. Affordable cost structures. Investing in stocks and choosing the right broker. Stock investing is one of the most effective ways to grow wealth passively over time. To begin, you'll need a brokerage account. This is what allows you to buy and hold investments like stocks, bonds, ETFs, and mutual funds. Your broker acts on your behalf, executing buy and sell orders. How to choose the best broker for you. 1. Understand your investor profile. Do you want to invest in individual stocks or funds? Are you a beginner, intermediate, or advanced trader? Will you invest for the long term or trade actively? 2. Check for proper regulation. Make sure the broker is registered with authorities like the SEC and FINRA in the US. 3. Pay attention to fees. Trading commissions, selling, transaction fees, transfer or withdrawal fees. Comparing these factors will help you avoid unnecessary costs and choose the best broker for your needs. The importance of demo accounts in trading. In today's fast-paced financial world, demo accounts have become essential, not just for beginners, but also for experienced traders. These accounts let you practice in a risk-free environment that simulates real market conditions. Why use a demo account? For beginners, learn how markets work, test platform tools, and practice trading techniques. For example, the MT5 web terminal on Exness. For experienced traders, test new strategies or get used to a new platform. For everyone, improve discipline, planning, and decision-making. Modern platforms offer realistic simulation tools for many financial instruments, helping you build the confidence and skills needed to trade in real markets. Learning basic trading strategies. Technical analysis. What it is and how it works. Technical analysis is the study of how asset prices, like Forex pairs or cryptocurrencies, behave by looking at past price charts and market statistics. The main idea is simple. What happened in the past can help predict what might happen in the future. It's all about understanding how supply and demand affect price movements. Key features. Can be used in many markets, Forex, crypto, stocks, and more. Uses historical data to find trends and patterns. Focuses only on price behavior, not news or company details. Technical versus fundamental analysis. Why combine both? Technical analysis uses charts to study price and volume. Fundamental analysis looks at news, economic data, or company reports. While some traders rely only on one type, many combine both to build stronger strategies. Example: oil and currency connection. When oil prices fall, currencies of oil exporting countries, like Canada, also tend to fall. In April 2020, oil prices crashed, and the Canadian dollar dropped too, a clear opportunity for traders to predict its future recovery. Extreme case: the pandemic and oil market. In 2020, COVID-19 caused a major drop in oil demand. U.S. oil storage filled up. WTI oil contracts even dropped to negative prices, around $37 per barrel. This was a rare but powerful lesson in market risk and volatility. Stop loss and take profit orders, tools to protect you. These are automatic orders that help you control losses and lock in profits, even when you're not watching the market. Stop loss order automatically closes a trade if the price hits a certain loss level based on the current price. When you set it, helps limit how much money you lose. Avoid emotional decisions in tough markets. Take profit order automatically closes a trade when it reaches your profit target. Helps lock in gains without needing to monitor constantly. Stick to a strategy with clear profit goals. Exit trades at smart points using technical analysis. Trading strategies, technical versus fundamental approach. When it comes to trading, there are two main types of strategies: technical analysis and fundamental analysis. Both are based on measurable and testable data, but they focus on different things. Technical analysis uses charts and indicators to find buy, sell signals. Assumes that all market information is already included in the price. Example: moving average crossover, short-term versus long-term averages. Fundamental analysis studies the economic and financial health behind the asset. Looks at things like company performance, interest rates, and economic news. Investment wisdom and behavioral traps. Charlie Munger, the legendary vice chairman of Berkshire Hathaway, once said, "The big money is not in the buying and selling, but in the waiting." Morgan Housel builds on this idea, reminding us that true wealth comes from patience and perspective. 1. Time perspective. Volatility is the price we pay for long-term returns. Investing for life means looking beyond short-term gains. 2. Psychological traps. These are emotional patterns that often sabotage our decisions. Herd behavior. Copying others out of fear of missing out. FOMO. Loss aversion. The pain of losing feels stronger than the joy of winning, especially common among retirees. 3. Specific challenges. These traps affect mostly beginners, people looking for quick, predictable returns, and they usually happen due to lack of planning, limited understanding of how markets really work. The real solution: keep your investment plan updated and realistic. Focus on understanding how the market works, not just chasing shiny opportunities. Develop strong trading psychology, master fear, greed, overtrading, and revenge trading. Managing emotions in trading. Having a solid strategy helps you stay calm and focused, especially during tough times. A good trading plan should prepare for different market scenarios. Avoid risking too much capital. Define when to enter and exit trades. Main emotional challenges. 1. Reacting to market swings. Stay calm during volatility. Don't make decisions based on short-term moves. 2. Revenge trading. Happens after a big loss. Trader tries to win it all back quickly. Leads to emotional, risky decisions. Often causes even bigger losses, and sometimes account blowouts. Some traders try to turn this into a strategy, but it's dangerous and rarely works. Alright, let's quickly recap the key steps we covered today. We talked about how to get started with trading the right way, from understanding the importance of a solid strategy to avoiding emotional trading and focusing on long-term goals. Remember, patience and discipline are your best friends on this journey. Trading isn't a get-rich-quick scheme, but with time, effort, and a clear plan, you can build real wealth and gain financial freedom. It's all about making smart moves and sticking to your strategy. So, if you're ready to take action and start learning more, I encourage you to dive deeper into these strategies. The market is waiting for you. If you found this video helpful, don't forget to give it a thumbs up, share it with others who are looking to get started in trading, and of course, subscribe to the channel for more trading tips and insights. Also, leave a comment with any questions or topics you'd like us to cover next. I'd love to hear from you. Thanks for watching, and I'll see you in the next video. Happy trading!